All right, so we seem to be stuck in between two real schools of thought right now. One where, on Evan Siddell's side, where he believes that the market is overheated and we really need to have a pullback on spending, of a pullback on the issuing of new debt, specifically mortgage debt, because he believes that most Canadians are over leveraged. And there's some truth to that. It just depends on what you mean by over leverage. Depends. I mean, if we're gonna look at like mortgage debt in the same way as we're gonna look at all other consumer debt like credit cards, car loans, things of that nature. I mean, historically, Canadians have a very low default rate when it comes to their mortgages. So, I mean, history doesn't always repeat itself. Doesn't always mean that that's going to be the case going forward. But his concern is that we're we're putting Canadians, putting the economy into an increasingly precarious situation, and we don't know when the music is going to end on this game of musical chairs. So what he's saying is we should kind of pump the brakes uh, instead of allowing the market to continue to I guess you don't really call it a rally, but to continue to have the gains that we have been seeing. That being said, is it appropriate for him to? It's in another video, but how appropriate is it for him to be making those comments given his position at CMHC? And the focus of CMHC um, is to maximize home ownership for Canadians. Really, their job is to think of new ways of creating new home ownership. So that's the interesting thing from that perspective. Now, on the other side, we have a floundering economy in a lot of ways. Well, because of the pandemic. So one thing that happens when you have a floundering economy, you need to boost consumer spending. How do you boost consumer spending? You can reduce interest rates. You can reduce the cost of money, right? And hopefully that gets the circulation going again. It's just such a weird environment that we're in, right? I mean, on one end, we we're in a bubble in one, which potentially, I guess, potentially. I mean, that's where what a lot of people are saying is that it is a bubble when it comes to real estate, especially in very specific markets. They're saying that the incomes don't justify the amount of debt, so at some point it's gonna give. But they've been saying this forever. There's really no way to make any prediction. It could happen at any time. Maybe it never happens. Who knows? Right? It's not an exact science, right? So the point is, you know, how do you manage that and at the same time boost the economy because it's very tricky. So what everyone was saying is that we need banks to reduce the amount that they're lending out. That CMHC has increased their standards for qualifications, right? So not as many people are going to be approved an insured mortgage, right? They've increased the credit requirements and they decreased the income ratios, so they're being more conservative. Now the issue is, well, not so much an issue, but one thing that they don't, one thing that CMHC can't control is the two other insurers that aren't viewing the market in the same way and aren't viewing the risk to their portfolio in the same way and haven't made any adjustments to their criteria. Now, I think what the difference is between the CMHC and Genworth and Canada Guarantee is CMHC is taking a national look and not just looking at their own bottom line as a crown corporation. All right, they're looking at it from the greater economy, right? I think that's the perspective that he's trying to take on it. Is he's trying to look at it from the greater economy, and Canada Guarantee and Genworth, they're just looking at it from their own pocketbook, and if they're which which is fine, right? If there's no fraud being committed and there's not taking any unnecessary risks, then what's the issue? What we saw in the US in 2009 is there was a lot of fraud that was being committed, and there was a lot of risk that was being taken because essentially those companies, those individuals were sheltered from the risks that they were taking with other people's money. So they were able to take those risks, and if they made the profit, then they'd get those outsized profits. And if they were to lose the money, then that loss is taken by somebody else. I mean, when you have a scenario like that, what you're going to get is a lot of reckless behavior, which is what they ended up with. We don't, from my understanding, from my point of view, we don't have such an environment that's taking place here. But I mean, I'm gonna go through the other article. Like, he was saying some things around the dark, dark aspects of the mortgage industry, and I'm very curious what he meant by that. But anyway, so let's take a quick look at this article, and let's see what the impact is for Canada. So the bar at which, well, let me start from the top. Yeah, yeah. So rates. So let's take a look at Canada's mortgage stress test level falls for third time since pandemic began. Rate falls to 4.74% to theoretically allow a borrower to be approved for a larger loan. Now, the bar at which the finances of Canadian mortgage borrowers gets tested has just been lowered, making it easier for would-be home buyers to reach. Now, I wonder to what degree this counteracts uh, the changes that the CMHC made. I wonder. I mean, you could because this doesn't change anything with regards to a client's credit profile, but what it would change is their income ratios, right? This would improve their ability to qualify with the same income. So, that being said, 5-year posted mortgage rates at Canada's big banks have inched lower in recent weeks, enough to compel the Bank of Canada to formally lower the average rate they base their calculations on to 4.74%. That's significant because this level so-called stress test is based on. That's Announced in 2017, the test was designed to cool the overheated housing market of the time by making sure borrowers would be able to pay back their loans if rates were to suddenly rise. And we haven't seen a sudden rise or sudden increase in interest rates. We were really concerned that there was going to be what do you call it, a normalizing of rates. So, I mean, the historical average of interest rates is significantly higher than what it is right now. So, obviously, this is bringing down the average. But, I mean, again, history is not a complete indication of what the future is going to be, right? I mean, things change. We're in a new environment, new scenario. I mean, who knows what's going to be a permanent fixture from the changes that were made due to COVID, right? I mean, who knows what the impact's going to be? I mean, there's been so many changes to the monetary system over the last 10, 15 years that I'm not sure if it's ever going to look anything like it did historically. But that being said, let's keep looking there. So even if a borrower could get a mortgage at, for example, 3%, that person's lender was obligated to crunch the numbers as though the rate was higher, at around 5%, for example, to make sure the loan wouldn't be too onerous for the borrower to pay back at their income level if rates were to suddenly rise. I mean, we were told a number of times that it doesn't look like rates will be rising for the next few years. I mean, and then the type of sudden increase that they're talking about would have to be fairly significant. So if the borrower failed the test at the higher rate, the lender wasn't able to lend to them, even if they wanted to, right? So that testing rate has already been lowered twice in this pandemic. Crazy. Just such a crazy time. The first was mid-March when it dropped 15 points from 5.19% to 5.04. And then again in May when it dropped another 10 points to 4.94%. And now this week's 15-point cut comes on top of that, and theoretically means qualified borrowers can now be approved for a slightly bigger mortgage than they could last week, even if their income is still the same. And that's the crux of it, right? So, I mean, we're getting it feels like we're getting like not so much mixed messages, but in a sense, right? We have the CMHC trying to cool down the market, and then um, we have we have changes on the other end where we're seeing people being allowed to qualify for larger mortgages. So rate comparison portal Rate Hub calculates that the change could increase the purchasing power for qualified borrowers by about 1.5%. But numbers show that what this means in reality is at the old level, a borrower who earns $100,000 a year has a 10% down payment would have been tested at 4.94% and be approved for a loan on a value home on a value up to 523,000 at the same $523,410. So essentially, they're saying there's about 7,000, close to $8,000 difference based on that scenario. Now, they're saying it's good news for buyers. Um, I mean, ultimately, when you're buying a place, it's understood that sometimes you may have to go outside of your budget or when you're looking for a home. But ultimately, you really should be buying a place based on what you can comfortably afford, based on the monthly payment. You shouldn't be looking at homes based on what the purchase price is. You should figure out you got to work backwards. What is something that you can comfortably afford? And it's not just a house or just a mortgage, but the whole lifestyle that comes with the home. So, how far is it from your work? How often are you gonna how do you need to drive? What's the cost of fuel? All that stuff. What's the cost on you? Because obviously there's wear and tear on you when you travel to and from a place. If it's an hour away, an hour and a half, or if you're spending 3 hours in traffic every day, and there's wear and tear on you. But all these things have to be factored in. I mean, a lot of people just work backwards. They just look at a place, they go in, they say, "Oh, this is a nice house. I want to buy it." They put in an offer, and then they find out if they can afford it. Like that doesn't make any sense. Find out what you can afford. Find out what you're willing. There should be a lot of thought that goes into buying a place. You should think a lot a lot about it, right? Not just the area, but a lot of it should be financial. Especially if you're buying it with someone, because the number one cause of divorce is still finances, right? So don't put unnecessary stress on your relationship just because you want to live in that house. Don't get so emotionally attached to a building, right? I mean, you want something that's safe, you want something that's secure, you want something that's functional. Yeah, you want something that looks good, I get that, but you want it to check off all the boxes, and you want it to be affordable. One of the most important things is that it's affordable, because it can either make or break your future finances, and you want to be able to have the flexibility to do other things, right? To manage yourself, manage your life. So these changes really shouldn't affect you as a purchaser, as a buyer, because you can still afford, like, you based on your budget, that's what you can afford. Whatever they can qualify you for is fantastic. I mean, that's great. That's a cherry on top. But that should be immaterial to what you're comfortable with for your financial plan and for your budget. That should be first. And then this part, what you can qualify for, should be of secondary concern. It should go in that order. Don't put offers in on houses before you've even discussed your finances. If you don't even have a budget in place, you shouldn't even be thinking about what can you buy. So, but yeah, they say it's good news for buyers, but I don't really think I personally don't think it should make much of a difference to buyers. It shouldn't. It only makes a difference to buyers when they don't consider their personal finances at all. So the kind of buyers that don't care about their personal finances are the ones that will go out and say, "Oh, great, I can qualify for more money now." Well, is that great? That just means you can take on more debt. Is that going to put you in a better situation long term? Maybe, maybe not. It just depends. I mean, unless you can have an answer for that question, should you be running in head first, just trying to get qualified for the maximum amount of money that a bank's willing to lend you? Because you got to remember, they're not your friend. It's a business, and they're gonna give you as much as is comfortable for them, not for you, right? And I think that's just something that has to be taken into consideration. Not to say that banks aren't bad; they're great. They're absolutely wonderful institutions because I work with them, and they're fantastic. Can't overstate that. But they're a business, right? They're a profit maximizing organization. You have to know what's right for you, and they know what's right for them, and that's what the relationship should be. You should just be you should manage within your comfort zone. Anyways, so I'm gonna bring this video to an end, and so tell me what you think though. Like, how does this? I mean, when you heard the news, did you think it's gonna impact you? I mean, do these types of changes? Do you feel like they impact you at all? Like, do you think they should impact you or your family or friends? I'm curious what your thoughts are. So, yeah, so I'm going to bring this video to an end and, yeah, talk soon.